Hi, in this episode of Accounting and Business, we'll be looking at the next two objectives, which are the opportunities in accounting and ethics in accounting, and the accounting standards and principles. In the previous episodes, we looked at accounting and record keeping, forms of business organizations, and users of accounting information. Those were the three first objectives in the topic, accounting and business. So we're looking at the next two objectives in today's episode. Accounting opportunities. Accountants may work as private accountants, public sector, government run and voluntary sector, that's the working with NGOs. The broad fields of accounting include the financial accounting, managerial accounting, taxation, and accounting related fields. That's the other fields that relate with accounting. For financial, it has to do with preparation of an analysis of statements, financial statements. That's the income statements, the statement of financial position, and the changes in equity, statement of changes in equity, and statement of changes in cash flow. Then auditing, regulatory issues, and planning. That is one section in accounting. Another is managerial. That's cost accounting, budgeting, internal auditing, management consulting, and general accounting. These are managerial opportunities in accounting. And taxation is the third one. That's tax preparation, tax planning, tax regulation, and regulatory compliance, tax consulting. Then other related fields that are to accounting: analysts, appraisers or underwriters in insurance, planners, traders, managers of accounting, and consultants. They are all opportunities in accounting. Accounting certifications in Canada. One is Certified General Accountant, CGA, Certified Management Accountant, CMA. Then Chartered Accountant focuses on focuses on managerial accounting. Then the one that focuses on financial accounting, chartered called collective, the Chartered Professional Accountants 2014. So these are professional bodies in accounting in Canada: CPA, CGA, CMA. Then Chartered Professional Accountant, Chartered Management or Certified Management Accountant, Certified General Accountant. They are professional accounting bodies in Canada. Then ethics and social responsibilities in accounting. We know in any field, just as in any field, there are ethics, there are principles that guide activities, that are moral principles that guide activities in that profession. So the same thing, accounting has its ethics. So ethics are beliefs that differentiate right from wrong. Ethics and ethical behavior are important to the accounting profession and to those who use accounting information. Ethical practices build trust, which promotes loyalty and long-term relationships with customers, suppliers, employees, and investors. Ethics they consider morality. They consider what is right over what is wrong. They try to differentiate between doing the right thing versus doing the wrong things. Ethics goes beyond legality in some cases. Ethics considers even things that are not directly or clearly written in law. It considers, is this thing right? Is this thing good to be done in this profession? Which means technically, even if something is not written verbatim in law, it can still be considered ethical if it is right. So in accounting, we look at ethical behavior, and in many cases we look at ethics in accounting as what guides professionals in this field in their daily activities. So ethical practices build trust, which promotes loyalty and long-term relationships with customers, suppliers, employees, and investors. So ethics in accounting. One of the primary goals of accounting is to provide useful information for decision making. In order for the information to be useful, it must be trusted. Accountants must act in an ethical manner in order for the information they produce to be trusted. Ethics. I mentioned something in the previous episode. Briefly, I talked about window dressing. Window dressing is preparing accounts in a more favorable manner than it is to flatter performance. It is considered unethical, for instance. Ethics goes a long way as to building trust of the preparers of the accounts being presented. So when the account is prepared and presented and interpreted, it should be prepared in a way that everyone using it will find trust in who prepared the account. So ethics guide all these activities. Then we look at ethical obligations of accountants. Overall, accountants are like stewards of or stewards to principles, owners of means of productions, or the owners of the business are considered the principal, and accountants have steward to principal relationship. So they are required to maintain a high level of professional competence, treat sensitive information as confidential, exercise due care and professional judgment, must not be associated with deceptive information in any form. Accounting standards. Accounting is a system that measures the activities of a business in financial terms by performing the following: analyzing, recording, classifying, summarizing, reporting, and interpreting. This sum up the activities of an accountant or functions related in accounting: recording, analyzing, classifying, interpreting, and communicating financial information to users for them to understand the position of the business, to aid their decision making, to have objective decisions made for the business or based on the information prepared by the accountant. It shows financial position of the business, and it is done by recording, by analyzing, by classifying information, by interpreting information, and by communicating the information to users. We had previously talked about the users of accounting information, the internal users, the external users. So you do all this to present information for these users at their respective times to understand the position of the business financial position of the business. And there is GAAP, Generally Accepted Accounting Principles. GAAP. These are procedures and guidelines that must be followed during the accounting process. They are used to ensure everyone prepares and interprets financial reports the same way. So we look at what we call universality, which means the way accounting is prepared in one place is the same as it's prepared in other places. As long as it is accounting profession and it has to do with financial reporting, it must be prepared in a generally accepted principle so that there is universality, there is uniformity, there is standard. You can, as a result of that, even compare financial statements of different years of the same business or of different years of different businesses in the same industry, or of the same year of different businesses in the same industry, because of GAAP that guides how accounting is prepared, how the financial statements are reported. It helps to do the comparison because it makes it universal and uniform and the same. GAAP is the accounting standard adopted by the U.S. Securities and Exchange Commission. So, comparing GAAP with IFRS, GAAP is generally accepted accounting principles. IFRS is International Financial Reporting. So, We look at this and compare them. GAAP is used in the US. IFRS is international, is about financial reporting. It's used in 166 countries, including the European Union, Asia, and Latin American countries. Canada currently uses IFRS. So, purpose of GAAP. The primary purpose of GAAP is to ensure the usefulness of financial information. In order for it to be useful, it must have the characteristics of relevance and faithful representation. Usefulness is enhanced if the information is comparable, verifiable, timely, and understandable. Accounting must be prepared such that it is relevant to purpose and it faithfully represents the business position. It must be true and fair. It must be comparable, as I said earlier. Accounting prepared by the business in a year or presented for a business in a year must be comparable with the previous years of the same business, or must be comparable with other businesses in the same industry. It must be comparable, it must be verifiable, it must be timely, it must cover a time period, a specific period of time, and it must be understandable. That is why accounting must be interpreted, it must be prepared as recorded, analyzed, interpreted, and communicated and interpreted for users in a way they would understand it totally. GAAP includes the following principles. That's business entity principle, cost principle, going concern principle, monetary unit principle, and revenue recognition principle. GAAP, generally accepted accounting principles, are the underlying concepts that make up acceptable accounting practices. Canada has recently accepted IFRS for publicly accountable enterprises, PAE. As of 2015, Canadian GAAP for all publicly accountable enterprises is IFRS standards. There is also another set of standards called accounting standards for private enterprises. IFRS, that's International Financial Reporting Standards. Companies that have their shares listed on stock exchanges must now adhere to a set of international accounting rules for financial years beginning in 2010. IFRS has been adopted by a large number of countries and Canada has joined the ranks. IFRS may be adopted by other companies as well, but it is optional. Canada adopted IFRS standards for most publicly accountable enterprises for financial years beginning on or after January 1, 2011. IFRS was established to try to achieve global agreement on the use of a common set of accounting standards. This is intended to make accounting information more comparable from country to country. Because of international transactions that happen and different international blocs like the EU, the AU, the United Nations, and for different other reasons, and for multinational businesses that have their establishments in different countries, and for a couple more reasons, it is important that accounting prepared in one country be comparable or has the ability to be compared with accounting prepared in other countries, which in essence suggests that there must be a standard that will be followed everywhere. If there is standard and this standard is followed everywhere, that means the product of the standards would be similar, would be the same, and can be compared one to the other. And that is one of the reasons IFRS was established. ASPE, accounting standards for private enterprises, are private enterprises that are privately owned, so they have some different reporting needs than public enterprises. For instance, public enterprises have responsibility to the public, and their reporting is to the public. They have to present their accounting to the public. Private enterprises do not have to present their accounting to the public, which means, and they must follow some standards, which means there must be a created standard for them also, although they do not prepare for the public, but they are still required to follow certain standards in accounting. And ASPE have significant parallels to IFRS, but there are some differences. ASPE was designed for private companies. IFRS is to be applied by public companies and other publicly accountable enterprises. However, private companies may choose to use IFRS. They should adopt IFRS when a business need requires it, which means public companies must use IFRS. IFRS is optional for private enterprises. Accounting standards for public versus private enterprises. Public is IFRS, private is ASPE or IFRS. So further differences between generally accepted accounting principles and international financial reporting standards, GAAP and IFRS. GAAP is based on legal authority. IFRS is based on principles. GAAP is more detailed and prescriptive, while IFRS is more high level and flexible. GAAP requires more disclosures, while IFRS requires fewer disclosures. Most Canadian companies use IFRS or ASPE for financial statements, but some companies must report with US GAAP to satisfy an investor, buyer, or lender based in the US. So we move to GAAP principles. Although GAAP for publicly accountable entities is IFRS standards in Canada, entities are permitted to disclose that they are in compliance with the GAAP in addition to disclosing compliance with IFRS standards. Now, the basic principles of GAAP are business entity principle, cost principle, going concern principle, monetary unit principle, revenue recognition principle. These principles guide accounting preparation. Principles that govern operation of a business accounting wise. These principles guide it. Business entity principle. Every business is to be accounted for separately from its owners or any other economic entity of the owner, meaning that the accounting for a business be kept separate from the personal affairs of its owner or owners or from any other business. For instance, the owner of a business should not place any personal assets on the business balance sheet. If the owner of a business, for instance a sole proprietorship, brings his or her personal assets to the business or gift it to the business, it will not be recorded as if the owner still has ownership of that asset personally. It will be recorded as capital or equity for the business because it now belongs to the business. So business entity treats business existence as separated from the owner's existence. If the owner gives to the business, it's recorded as equity or capital. Not that the owner's personal property will be recorded in the balance sheet of the business. No. Business entity principles requires that those things that belong to the owner be recorded separately. Those things that belong to the business be reported for the business. Cost principle. All transactions are recorded based on the actual cash amount received or paid. In absence of cash, the cash equivalent amount of the exchange is recorded. What's the cost of an item you bought? You record it. For instance, if an asset, let's say machinery, was purchased for a certain sum today, in the next 10 years, should we, or in the next 2-3 years, should we, because the value of the asset has increased or reduced, as the case may be? Usually a machinery would reduce in value. Landed property can appreciate, but I mentioned machinery, so machinery would usually reduce. So because the asset would have reduced in 3 years time from what it is now, that doesn't still change the cost price that was paid to obtain that asset. So when we are reporting the asset, the cost price will still be recorded, and to get the accumulated and to get the net book value, we will deduct the aggregate depreciation as at the time we are recording. So if it is 3 years time, cost will still be recorded as the original amount that was purchased for. Then we deduct the accumulated depreciation as at that date, next year, next 2 years, next 3 years, next 4 years, as the case may be, but cost will remain the same. Going concern principle. Financial statement users can safely assume that the statements reflect a business that is going to continue its operations instead of being closed or sold. So it is assumed while preparing the accounts that the business entity will continue to exist till foreseeable future, till perpetuity. The business will continue to exist even till next 1 year, till next accounting period. So for instance, when income statement is prepared for the period ending, believing with the assumption that there is going to be next period starting immediately. It's believed that when an accounting period ends, the business is not liquidating, it's not ceasing its existence in quote. So that means the accounting is assumed that business existence will continue to go, will keep going. Yeah, that's going concern principle. The business existence will keep going till perpetuity. So this is the assumption that the business will be able to continue operating for a period of time that is sufficient to carry out its commitments, obligations, objectives, and so on. Monetary unit principle. This is very interesting. Requires that transactions be expressed using units of money as the common denominator. It assumes that the monetary unit is stable. Adjustments are not made for changes in currency value or inflation. It implies that business transactions should only be recorded if they can be expressed in terms of a currency, in monetary terms basically. So which means transactions, events that happen that affect the business, that add economic value or deduct economic value, whichever way, and can be quantified in monetary way, is to be recorded. Anything that cannot be quantified in monetary value is not a business of an accountant. Whatever happens that has monetary value, that can be quantified in monetary value, is what accounting deals with. So that means an example would be our level of training of workers. It has a long way in affecting the business productivity, yes, but if it cannot be quantified in monetary terms, then it is not an item that goes into the accounting books. Training are many different things, including good reputation in quote of a business that is not paid or purchased. You are not able to quantify it in monetary terms. So until you are able to quantify it in monetary terms, that's when it goes into the books. Then revenue recognition principles. Okay, before I go to revenue recognition principle, another emphasis or something to place on monetary unit is, if it is not recorded in monetary terms, it does not go into accounting books. That's like a slogan. Not money, not recorded monetary wise, not going to accounting books. So basically you can say accounting is about money. It records what can be quantified in monetary terms, in currency terms. So fifth principle is the revenue recognition principle, which requires that revenue be recorded at the time that it is earned, regardless of whether cash or another asset has been exchanged. The amount of revenue to be recorded is measured by the cash plus the cash equivalent of any other asset received. So you recognize revenue the moment service or item of value has been exchanged for it. For instance, a merchandising business, the moment goods have been sent out to the customer and the customer has received and acknowledged the receipt, you have earned the revenue and must recognize it immediately. Whether the customer pays the fund immediately or is going to pay later, it is recognized at that time. Revenues are not recognized when the client or customer pays for the service or goods given to them, or him or her, or the business. Revenue is recognized when the service is provided. So when a business provides service to customer, revenue is earned at that point. The customer may pay immediately, good. The customer may pay later, that's also possible. So, but the time the customer pays is not what makes the revenue to be recorded. It is the provision of service completion. When you complete the provision of service, or when you complete the delivery of the product to the customer and the customer has acknowledged the receipt of the product, then you have earned income. So you recognize the revenue at that point. This will be the end of the fifth objective of accounting in business. Thank you very much. If there is any question, perhaps, please be free to drop your question in the comment and it will be attended to accordingly. Thank you.